Alright, in this video, let's do exercise 19.4 in the book. And so this is about deferred tax assets and deferred tax liabilities. This one's a little tricky, so we'll get into why that is. But big picture, we have pre-tax income here. And the tax rate is 30% in this problem. That's going to give us income tax expense. Right. On the other hand, we have taxable income. Going to multiply that by 30%, which is the tax rate in this problem. And that's going to give us income taxes payable. Okay. And in the problem, they go ahead and tell us that the pre-tax income is $70,000. All right. And the reason the problem is tricky is that this problem has a permanent difference. So whenever you have a permanent difference, this little formula here, this whole picture, doesn't quite work out exactly. Okay. And you're actually going to want to back solve for this one here. Okay. Normally, if it's a typical problem they give you with no permanent differences, I would just take the 70,000 times 30%, and I'll say that is my income tax expense. I definitely want to do this problem for you guys because it's a little different. But anyhow, let's get into it. Taxable income. What is that going to be? Well, let's take our pre-tax income under U.S. GAAP of 70,000, and let's convert it. Okay. And we're going to convert it. We're going to look at all the differences. That's how we're going to do it. The first difference they mentioned, your depreciation on your tax return is $16,000 more than the depreciation on your income statement. So if I want to convert, do I need to add or subtract the 16,000? I'm going to need to subtract. Right? I'm converting to taxable income. I'm converting to IRS. And IRS says, hey, our depreciation is $16,000 more. So you better be subtracting $16,000 more than you had subtracted for your purposes. Number two difference. Okay, the rent collected on the tax return is $22,000 more than the rent that you collected on your income statement that you got to recognize. So we're going to take the $22,000. We need to add it. We are trying to be taxable income. Okay, so if they say $22,000 more rent revenue, then that's what we have to add in. Now, the third difference, this is what makes the problem a bit tricky, is the permanent difference. Point 3 says that you paid pollution fines of, let's see, $11,000. So on your income statement, you have some kind of expense or loss. It says, fine for pollution. The IRS never allows you to ever expense that. That's real money that you had to pay, but they're like, no, you should not be breaking laws. Okay, so permanent difference, meaning the IRS taxable income is permanently higher than the U.S. GAAP income by $11,000. Meaning taxable income is $87,000. Okay. All right. So that is the situation there. Let's just try and do the journal entry here. The journal entry is always going to be like this for these problems, guys. Income tax expense. We'll leave a couple spaces. Income taxes payable. It's like a sandwich. This is the bread. The bread's always there. What's in the middle changes, but the bread's always there. 87,000 times 30%. Let's see here. 8 times 3, 24. 7 times 3 is like 21, 26,100, right? Okay. So that is taken care of right there. However, again, because of the permanent difference, I cannot simply take the 70,000 times the 30%. I can't do that. I can't do that. I'm going to have to leave a big box there. We're going to have to fill that in a minute. Let's look at what else is going on in this problem. You have a deferred tax asset and deferred tax liability. You got those temporary differences there. So with the rent, let's see. The rent collected on the tax return is greater than the rent you got to recognize under US GAAP. So essentially, you paid taxes on some rent revenue that you didn't even get to recognize right now. That's bad. But that will be good in the future, right? In the future, the next rent revenue, when you actually earn it for US GAAP purposes, you won't have to pay taxes for it. So because that'll be good in the future, that is a deferred tax asset, DTA. The opposite is true of the depreciation situation. You are subtracting more for depreciation under the tax code than you are for your financial reporting. That's great right now. You are saving taxes. But in the future, that will reverse, and that will be bad. So that is a DTL, deferred tax liability. So for the journal entry then, your DTA is going to be the 22K times the tax rate of 30%. It's going to be $6,600. Your deferred tax liability is going to be the 16,000 times 30%. 4,800. Okay, and so you're actually, when you have a permanent difference, you want to back solve for income tax expense here. And so if we do the math here, let's see, the credits are 30,900, and I got to subtract 6,600 from that. 24,300, I'm pretty sure. Yes, all right. And so that would be the journal entry. Okay, I think that's probably the more difficult part of the problem, and I would definitely want to cover that. Let's go ahead and do the other part of the problem, parts C and D here. What does this button do? Can I move it? There, I can just move it. That's pretty cool. So for part C, the income tax section of the income statement, you say income before income taxes. And so for that, you would look up here and say, okay, pre-tax income, $70,000. And then you'd have income tax section, income taxes. We have current and deferred. You're going to add those up and get a total. And then you're going to have net income after that. That's kind of the structure of it. Okay, and so for current, if we look at this problem here, the current that you actually have to pay is going to be, just a second, it's going to be 26,100. That's the amount you actually owe right now. And then you look at the deferred, you're going to net the deferred, the DTA and the DTL. Okay, and you're going to say, okay, net DTA is greater than DTL, so the deferred is negative. It's going to be the 4,800 minus the 6,600 there. Okay. So again, current is the amount I actually owe right now, and deferred is negative 1,800. Again, that's the DTA minus the DTL. And so the net $24,300 is your net income tax expense, which should look familiar. That is the income tax expense you made your journal entry, so has to be like that. Meaning your net income is, let's see here, 46, 45, 700. Pretty sure. Okay, that's part C. That is how that would look like. For part D, they ask, was the effective income tax rate. So the effective tax rate, sometimes called the ETR. I take my income tax expense divided by the pre-tax income. Simple as that. 24,300 divided by 70,000. Whatever number that comes out to be, that is the answer. ETRs are widely looked at. If you're a CFO, Chief Financial Officer, you'll be judged based on your ETRs. Try to be efficient, get a low ETR and such. Anyhow, that is it for this video.